Facebook's IPO in 2012 was a disaster, with a crash in stock price, confusion, and lawsuits. And today we will break down what happened and why. I guess I don't need to explain what Facebook is, but I do want to remind you about the context of 2012. Facebook was founded in 2004 by Mark Zuckerberg and quickly grew to become one of the largest tech companies. For your understanding, today's Facebook is huge, but it's not that influential as a social network anymore. But it was different back in 2011. Facebook was the social network where everyone was hanging out. Despite being extremely dominant, they still were a private company. Mark Zuckerberg was resisting an IPO or buyout offers for a long time. This resistance to do an IPO led to some early investors and employees selling their stock on private markets, which, ironically, was the main pressure factor to consider going public. At some point, the number of Facebook shareholders exceeded 500. Which is the SEC regulatory threshold. Once you hit 500 shareholders, there is some extra regulatory pressure, which is making it harder for the company to stay private. Another obvious reason to consider an IPO was pressure from employees and investors, who wanted to see some liquidity for their hard-earned stocks. So, in 2011, Facebook started the IPO preparation, which is usually a combination of a lot of paperwork and some public work, such as meetings with institutional investors. Typically, you work with several investment banks as so-called underwriters, and they support you end-to-end, from the initial filing to IPO day and beyond. Mark structured the IPO the way he still kept the voting control of the company even after it went public. In February 2012, they filed for an IPO with the SEC, basically making their IPO plans public and official. Soon after, in April, another big news came in. Facebook was acquiring Instagram, which was relatively small but extremely fast growing. The first controversy happened during the pre-IPO roadshow. Mark was wearing a hoodie when meeting with the potential investors, which made some negative news, as if he is not serious about the IPO or not mature enough to run such a large company. Nevertheless, based on the roadshow results and the hype in the news, it was clear that the demand for the Facebook stock is huge. So, days before the IPO, underwriters revised the originally set targets. They pushed up the IPO price from the originally planned $34 per share to $38. Also, they decided to increase the number of shares to be released to meet the expected demand. Later, we will see how these decisions backfired. Finally, in May 2012, we come to IPO day. The night before the IPO, the Facebook team celebrated it with an all-night hackathon at its headquarters in Menlo Park. Mark remotely rang the NASDAQ opening bell from the Facebook campus. Everyone was excited and optimistic. Problems started with the NASDAQ exchange. It had lots of technical glitches on that day. First, trading was delayed for 30 minutes. Second, throughout the day, they faced trading order confirmation issues. Many traders had no idea if their orders went through or not, which created a lot of uncertainty and confusion. The stock price initially rose to $42 and then moved back to $38. And underwriters had to aggressively buy the shares to make sure it's not dropping below the IPO price. Trading day 1 closed at $38.23, which is a flat close and considered a failure for the IPO of this size and hype. The next trading days faced the continued selling pressure. At some point, underwriters stopped artificially supporting the price, so it fell below the IPO price. Then, some institutional investors decided to exit or reduce their positions, which further affected the price. Now, it was trading around $20 range. In August, 3 months after the IPO, the price hit the rock bottom of $17.5, a 55% decrease from the IPO price. Soon after the IPO, lawsuits were filed against Facebook, NASDAQ, and the underwriters. The main accusation was that Facebook shared the news about the company's slowdown selectively, only to a few investors. As you can guess, Facebook's reputation as a public company started very rocky. The IPO was widely considered as a failure, with investors and underwriters losing a lot of money. Main reasons were, first of all, greed. The IPO price was set too high, with too many shares released at once, basically oversaturating the market. Second, Nasdaq technical issues ruined the momentum and confidence. Finally, Facebook had one major gap, which is mobile monetization. Basically, at the time of the IPO, they had no mobile ads and no clear strategy on how to implement them. And this gap made many investors concerned, considering the mobile market was growing rapidly. Good news is, all these issues were fixable. Facebook was still the company owning two dominant social networks with huge user base and strong fundamentals. So they analyzed their shortcomings, locked in, and heavily focused on their gap area, mobile. And here, I'd love to say they implemented some new amazing features that improved user experience also. But no, what they did was implementing native mobile advertising. Basically ads that look like regular posts in the user feed, which obviously not a great change for users, but ended up being amazing for Facebook's revenue and earnings reports. And the stock eventually picked up. In mid-2013, it returned back to the IPO price and then further skyrocketed. Today, Facebook's stock is worth around $700, about 17 times higher than its IPO price. Moral of the story, ads are good. Just kidding. Facebook was one of the worst IPO debuts and ended up being one of the best long-term tech investments. The moral would be, failures do happen, but you should persevere and don't get too distracted by them. And of course, think long-term. Thanks for watching. If you enjoyed, click like and subscribe as more stories are coming soon. See ya!